Good evening, everyone. I extend a warm welcome to all of you. Thank you for attending today's earnings call for Q1FY23. Our immediate environment continues to be dynamic owing to geopolitical issues and its consequences. Like increase in energy prices have driven up inflation globally. In India, RBI has been taking relevant measures, including hiking interest rates to contain inflationary pressures. Amidst all this, according to industry experts, India stands at a better position currently in comparison to other economies in the world. RBI expects India's GDP growth to be 7.2% in current financial year. The consumer confidence showed continued recovery as per RBI's Consumer Confidence Survey. Credit card spends have also followed the suit, with monthly spends having stayed above rupees 1 trillion consecutively. The credit card industry, which has shown consistent growth despite changing economic environment, is undergoing a positive shift with many conducive regulatory changes being introduced in the past few months. As per new RBI master direction, some changes are already in force from 1st July 2022 and some have been deferred to 30th September. All the guidelines issued by RBI are progressive and basic approach is cardholder convenience and protection. At SBI card, we are complying with all the guidelines which were to be implemented on 1st July 2022. We have already sent relevant communications to portfolio inactive cardholders in line with the RBI guidelines through various channels. Whereas the percentage of such customers is low, moreover, we expect a large percentage of such customers to be retained. With respect to the guideline on 30-day activation for new customers, implementation deadline has been extended by 3 months and hence the same will be rolled out by 1st October. Further, RBI has given multiple options for considering a customer to be active. Another change relating to over limit will come into effect from 1st October 22, which will also be basis customer choice. This change is similar to online transaction switching activation. There is a possibility that initially customers may find it difficult to adopt to the change, but as is the case of online transactions, we expect that the change in OVL may stabilize over a period of time. Another change introduced by RBI is enabling RuPay credit card transaction on UPI. Discussions are going on with various stakeholders in this aspect. We are working on technology integration while NPCI is in discussion with all the stakeholders on MDR. This is expected to be resolved shortly. As the industry evolves and grows, SBI card continues to be one of the significant contributors to the growth. Let's now look at SBI card's business overview in Q1. We were able to deliver a healthy business growth with strong financial performance during the quarter. Before I proceed with the details of the business performance this quarter, I would like to share 2 key recent honors with you that we have received as an organization. I am happy to share that SBI card has been certified as Great Place to Work for March 2022-23. A key milestone for us because our employees are our most valuable asset. It is also a testament to our efforts in creating a healthy work culture focused on integrity, respect, transparency, and trust, which is conducive to the growth of our employees as well as the company. As a brand, we continue to be recognized in the industry for our initiatives and efforts. We have recently been recognized as Best BFSI Brands 2022 by the Economic Times for the 3rd consecutive year. As you can see, we entered this fiscal year on a positive note and the same is reflected in our business indicators for the quarter as well. In Q1, we achieved the milestone of 14 million cards in force that contribute 18.4% of the market share in the industry. This milestone is an indicator of our consistent growth trajectory. This quarter, we sourced over 900,000 new accounts, which is a tad lower than 1 million mark, which we recorded in the previous quarters. However, the small drop in the last quarter is due to cyclical banker sourcing variation. We have already started working on fresh set of leads in banker, and the July numbers are much stronger. Our overall spends continue to see a healthy growth and has grown by 79% year-on-year, standing at 59,671 crores in Q1 versus 33,260 crores in Q1 FY22. Our spends market share as per the information available in the public domain as of May is 18.6%. Retail spends stood at 45,488 crores versus 27,098 crores in Q1 FY22, an increase of 68% year-on-year. Online spends continue to grow consistently, and these now contribute to over 55% share in overall spends. Noticeably, it's heartening to see that key spend categories have crossed the pre-COVID levels, including travel and entertainment category. While categories like departmental stores, health, utilities, education, consumer durables, furnishings have seen a steady growth of 7%, travel and entertainment category has seen a growth of 31% in total spends in Q1 FY23 versus Q4 FY22. Corporate spends are at 14,183 crores as compared to 6,162 crores in Q1 FY22. However, in the month of June 22, we have reviewed and reduced some B2B spends on certain low-margin corporate accounts. This is in line with our continued focus on sustainable and viable growth. Most importantly, our spends per average card has seen a significant growth. It has risen to 1.7 lakhs in Q1 FY23 from 1.1 lakhs in Q1 FY22. This is a good indicator of customers' growing preference for SBI card as a payment option. It has been driven by various attractive and relevant discount offers and initiatives that we have offered to our customers. Our revenue streams remain healthy and diversified. The revolver mix has grown to 26% in the current quarter from 25% as of March 22. EMI mix has also grown to 35% as compared to 34% in the previous quarter. To further improve our revolver mix, we have been recalibrating our risk appetite. During the quarter, we continued to augment our product offerings to our customers and expanded our co-brand portfolio with the launch of Aditya Birla SBI Card, one of the most rewarding lifestyle credit cards in partnership with Aditya Birla Finance. Please allow me to take you through the financial performance in Q1 FY23. All the positive business indicators have supported our financial performance. Our resilient business model embedded on strong fundamentals have helped us deliver healthy financial growth. During Q1 FY23, our revenue performance continued to be led by healthy interest income and strong fee growth. The company has achieved a PAT of 627 crores in Q1 FY23, a growth of 106% year-on-year and 8% quarter-on-quarter. In Q1 FY23, receivables stood at 33,215 crores with a growth of 36% year-on-year. Our total revenue stood at 3,263 crores and has grown at 33% year-on-year during the quarter. In spite of a 25 basis point increase in cost of funds, our NIM remained constant as the interest income yield also improved. In the rising rate scenario, we are hopeful that the impact of the same may be partly mitigated by increasing the share of interest-earning assets. On asset quality, our gross credit cost percentage has considerably declined to 5.6% from 10.4% a year ago, and the net credit cost percentage has also declined to 3.8% from 9% in Q1 FY22. Our GNPA has come down to 2.24% as compared to 3.91% at Q1 FY22 and 2.22% as of March 22. Net NPA for the period is at 0.79% as compared to 0.88% as at Q1 FY22 and 0.78% last quarter. Return on average asset for the quarter is at 7%, which is higher by 247 basis points as compared to 4.5% for June 2021. Return on average equity is over 30.8%, which is higher by 1,217 basis points as compared to 18.7% for Q1 FY22. Our liquidity position continues to be strong and capital adequacy is robust at 24.7% for the period ended June 22. In conclusion, as mentioned earlier, prevailing external environment poses some challenges. However, thanks to the domestic consumption story, India is seen as a strong contender to be the world's fastest growing economy over the next few years. India's digital economy is going to play an important role in the growth, and it is expected to reach around $800 billion by 2030. Notably, digital payments in India are expected to reach $10 trillion in value by 2026 from around $3 trillion now. This presents a strong potential of growth for credit card industry. As we continue with our preparations to make most of this opportunity, we remain vigilant in the current situation. I would like to reiterate that at SBI Card, we have built a robust, reliable, and resilient business, and we are committed towards delivering value to our shareholders, employees, and customers. Rituja, now we are open to questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question and limit their questions to 2 per participant. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Anuj Singla from Bank of America. Please go ahead.
Yeah, good evening, everyone, and thanks for the opportunity. The first question is with regards to the sourcing mix on the new account. So we have seen a very dominant presence of open market. I think you did talk about some issues on the banking side as well as some, recalibration of risk appetite. Can you please elaborate on that? Are we consciously going slow on Project Shikhar? And secondly, what does it imply for the credit cost going forward?
Yes. Yes, the share of banker has come down in the month of June quarter. Generally, also the banker's contribution, particularly in the month of April, when it is a busy audit period for the branches, SBI branches, which actually play a critical role in terms of sourcing, they are preoccupied with audit. So, month of April is always like a contribution is low. But as you know, like a Shikhar version works on, at certain intervals we get the data. We mean like a branches dashboards are populated with the data. In one cycle there was a delay, which has actually resulted in slight slowdown in terms of sourcing. But we also clarified when the position got rectified in the month of July. So now we are seeing a usual run rate, usual contribution from banker channel. So as a strategy, there is no change. We continue to look for a 50% contribution from both banker as well as open market. Rather, when we were faced with a situation of slightly delayed or a kind of lower contribution from banker, we were able to ramp up the open market channel, which shows our resilience in terms of maintaining a monthly run rate of 300,000, which we always advocated for. So there is no recalibration of risk as such. It is only like a tactical move. And the quarter 2 will reflect most probably the same contribution mix as we always emphasize.
Okay, got it, sir.
Would you like to comment on the credit cost?
Yeah. And the second question is regarding the cost of funding. Obviously, we have started the impact. It has started to flow through in our P&L. So when we look at for the next 3 quarters, what kind of cost increase should we be factoring in?
I think it all depends upon, as you know, like a 60-65% of borrowing is a short term, and here also when we call it short term, they have a different frequency at which they get reset. So, but our understanding, our estimation says like a bulk of the impact will come in Q2, and unless and until again the external benchmarks or repo rate changes, there may not be further impact to the same degree in the subsequent quarters. So we feel like a Q2 will reflect the full impact of increase in the cost of funds. But at the same time, you would have seen the shift in the composition of assets where we are consciously increasing the share of EMI loans, which has been steadily increasing. Revolver has also started responding, albeit in a very small way. We are hoping that the share of interest-earning net assets will continue to increase, and this will help us actually to kind of take care of or mitigate whatever the negative impact is there on account of increase in the cost of funds.
Okay, got it, sir. Any quantifications for second quarter? What kind of increase we can build in?
So Anuj, that will be, I think the full pricing impact will come in. It will be range bound between 5.6 to 5.8. That's it.
Okay, great. Thank you very much.
Thank you. The next question is from the line of Dhaval from DSP. Please go ahead.
Yeah, hi sir. Congratulations on good set of numbers. I had three questions. First was relating to the net card additions. So we talked about your aspiration to have 3 lakh net monthly card additions. I just wanted to understand when do you see this sort of run rate being sustained, achieving and sustaining. Any color that you can provide? Are we 2-3 quarters away, or any color around that would be useful. The second question is relating to a revolver share. So we've seen increase this quarter. Just wanted to understand. In terms of the sort of bottoming out of revolve share, is that behind us, and gradually given our incremental sourcing moving towards potentially higher category of revolver customer base, do you see it gradually increasing quarter after quarter? So just some color around your confidence on this upward shift that we've seen in the quarter. And last question is relating to spend-based fee. So we've seen the T&E sort of spend come back. I was hoping the spend-based fee as a percentage of the spend also start to move up. They've been around 1.4% level pre-COVID. We used to be about approximately 1.6% level. If you could give some perspective around is it the new normal, or we should see that increasing, and what could drive that? Yeah, those are the three questions. Thanks.
Yeah, as I said earlier, our initial idea was like a gross card issuance of minimum 300,000 per month. That was always there, and then gradually increasing it within the kind of this appetite what we have, and the competency, the capacity of the channels. And our intent was evident till the last quarter, where we increased and ramped up the gross card issuance, where it crossed 1 million. So that effort will continue despite whatever small hit we have seen in the June quarter. So the effort on increasing the gross card issuance will be aided by the continuing expansion of the partnerships, and even the new digital channel what we have launched for end-to-end digital channel for sourcing NTB. This will also help. Of course, net growth is also a function of attrition. So attrition, I think we are taking a lot of strategies in terms of addressing the attrition. I think month of July or August, a couple of months, because the mass direction is coming into effect, that can actually have some impact on the attrition. But I think once this impact is absorbed, then definitely it will be like, again, the net growth will be on a growth trajectory. Net growth in the card will be definitely increasing. And the 300,000 net growth is continuing to be an aspiration. Definitely it will be there, and we are sure, like after a quarter, we will be in a better position to reach that number. With regard to revolver bottoming out, Girish, can you?
Okay. So, with respect to revolver, we have seen not only an increase in the asset, but this asset has also come on account of number of customers. So, fundamentals look to be in place from a percentage of asset on the revolve portfolio. So, we get that confidence that this is going to sustain in that sense. The other good part is that we continue to see an increase on the term book, which is now up at 35% of the overall asset. So if you look at actually in the last quarter, the interest-bearing asset has moved by 2 percentage points up to almost 61%. So while we continue to get more interest-bearing asset on our part, and also focus on the quality of customers that we are getting in, so that our future revolve book is built accordingly. So both the things are working in tandem. So you can see that from both the data points. So that was on the revolve share. On the spend-based fees, you are right. While it will not go back to the original number, because during the COVID period, a whole lot of new category of spends has got added, which is in terms of either utilities or insurance payments, fuel has increased. So some of those categories are at a lower interchange. However, from the point where we are seeing an increase in travel. In fact, in our investor presentation this time, we have presented that the travel has also crossed the pre-COVID numbers both travel, lodging, entertainment, all those categories in Q1 have crossed that, and they continue to show very good growth. So we should see an upward trend from where we are, maybe not at the original number of COVID, but somewhere in between it should land.
Got it. Thanks and all the best.
Thank you. The next question is from the line of Abhishek Murarka from HSBC. Please go ahead.
Hi, sir. Good evening and congratulations for the quarter. Few questions. One, when you in your opening remarks, you said that you have recalibrated some risk metrics to get more interest-earning assets. Can you just give some examples of what exactly you have done? That's question one. Question two is on the co-branding with Aditya Birla Finance. Can you just share some details in terms of how it will work with respect to data sharing and what are the commercials of the tie-up, and how do you expect this to scale up in the next 2 to 3 quarters in terms of, let's say, card issuances or whatever? And finally, on commercial spend, you said you ran down some B2B accounts. What does this mean? Is it a product that you are finding pressure on in terms of the profitability, or is it a group of corporate which is not remunerative? Can you please explain that? Thanks. Those were my questions.
On the first point in terms of recalibration, I think that's something we've been saying now for the last 2 or 3 quarters. As our overall credit costs have started coming down, the principle we've been following is to try and optimize our credit costs. So even on an ongoing basis, we're constantly looking at segments where we believe we can recalibrate the risk appetite, and that has been happening now for the last 2 or 3 quarters. And you would see that even in terms of the number of self-employed that's gone up in recent quarters. So this is an ongoing exercise. There's nothing specifically that we've done in this quarter. See, a lot of these actions do start to bring in that kind of customers who have a higher propensity to revolve. That's all. I don't think you can change the risk appetite and start getting in more revolvers. It's not that simple in arithmetic.
Right. Okay, but in your estimation, is there like a lead time, or what do you expect? Maybe 2-3 quarters and it could translate into some more revolves?
So, see, really, it's a question of what are the actions that we can take, and there are 2 or 3 sets of actions that we've been taking. We have obviously reworked our risk appetite to start bringing in more self-employed, second-tier salaried customers. We've also tried to bring in some of the thin file customers with additional data, because we now have rebuilt our models, we have access to alternate data, so we are bringing some of those customers also. And there's a lot of other activity that is happening on the marketing side to induce spend, try and get more of the discretionary spends and things like that. So it's a set of actions. We'll have to wait and see how that pans out.
Got it.
On the Aditya Birla Group, we tied up with them, and the model that we are going to use there is, because they are also a regulated entity, so we have done a very detailed DRE exercise with them. We have already qualified and selected certain set of customers where we can give the card without taking any documents. We are intending to use our newly launched straight-through processing SBI card sprint that you would have seen, that journey for these set of customers, so that we are able to give the offer to these customers and be able to get these customers. And in this case, it should be easier for us because Aditya Birla Group being a regulated entity, we don't need to collect another KYC of these customers. So we are working at seeing whether in certain cases where we collect the KYC or where we would not, so that make even life simpler for the customer. So that's the model that we are going to use with Aditya.
And what is the profile of these customers?
Asset customers, they are basically asset customers of Aditya Birla Finance, so which would have taken either a set of various kinds of loans being offered by the Aditya Birla Financial Services and capital. On the commercial spends that you asked, it is not a specific product. On the commercial cards, there are some corporates who do B2B spends or vendor payment spends or some kind of statutory payments. Now, in some of these cases, because some of these spends go through various aggregators, and if the costing keeps changing or the pricing moves in a direction where it becomes non-profitable, so on review on some of these cases, on some of these spends, we saw that some of that spend was not in line with our expectations. So for the time we have curtailed some of that and reduced some of that, because it's not only about the top line, we also intend to be looking at the profitability from these spends.
Got it. Thank you.
Thank you. The next question is from the line of Bhavik Dave from Nippon India. Please go ahead.
Hi, good evening, sir. Congratulations on a good set of numbers. Sir, a couple of questions. One is, you mentioned that the term loan book proportion is increasing. Just wanted to understand what will be the average tenure of this book at this point in time?
There are actually three portions of that. One is a kind of almost a loan which is given on top of the credit card limit. There the term is almost 33 to 34 months. On the spend, which is converted into term product, there it is almost close to 8.5, 9 months.
And what would be the broad proportion if you're comfortable with the 35%? How much of it would be more than like a couple of years or 30 months?
So you can go through our ALM and have a look at that, because there we declare that more than 12 months, I think is there. Right. But otherwise, we have not declared these specific numbers.
Perfect. All right. No problem. And sir, secondly, and I see that we've come up with that sprint offering, and I think I'm assuming that this is the end-to-end digital origination that we were planning, and we started some bit for the banca customers, and now I think this is more for the open market. I just wanted to understand how exactly has the banca experience been, and how do you think that this can help us again make it the onboarding journey more efficient and cost effective? So anything on that you would like to highlight?
Yeah. Sure. So you're spot on, and this is Pradeep answering on behalf of SBI. So basically, this new journey is launched for the open market space. As you are aware that for our digital sourcing with respect to State Bank, we already have an existing integration on similar lines in the YONO app. Now, through the YONO app, accounts have already been coming for a while, and the whole architecture is designed in a way that, once the customer consents, data is automatically integrated into our system, so data gets picked up automatically, gets passed over to us. There is, however, a KYC leg that currently we do even for the banca customers, so that gets done on our side. But by and large, the digital route for those customers already existed. So that's on the integration with banca. What we are going to do now is, since here, we have integrated this whole app and launched it for the open market space. This new app gives us a lot more capability. So the first and the foremost is that the user experience is pristine here. It's completely seamless. KYC is completely digital. What we've also done is the decisioning on the account is real time, as well as all the checks and balances in terms of photo match, which is done using artificial intelligence. We also do our fraud checks, which are also completely online. And net in approximately 4 to 5 minutes in one single journey, the customer can get a card online. So numbers have started coming in on this new app. And some of the features here, which we are in an early stage on the open market side, we will also bring onto the YONO platform. So that's a separate effort once the success is proven in the open market space. Some of these features that we like will also get rolled out on the YONO side. So in a nutshell, what I want to say is that the path for our company moving forward is going to be digital centric. The new account acquisition strategy is going to have a digital first approach, and this digital first approach we will adopt both on the banker side as well as on the open market side.
Sure, sir. And sir, last question is on the sourcing bit, and I see that tier 3, tier 4, tier 3 and above, or tier 3 and tier 4 cities incrementally is adding to almost 50% of our incremental sourcing, which used to be 25-30 odd percent. Anything that we are seeing here, are the customers better? And we've discussed this previously on the type of spends that they do and the kind of revolves that they can generate. But is there enough, or is there lesser competition in that market? And does SBI have a more right to win kind of a proposition with these customers, considering the familiarity with the brand? Or how does it work? And what would be the economics, like in the sense the cost of acquisition would be similar, or will it be lower for a tier 3, tier 4 kind of customer? That's about. Thank you.
So 3-4 things I will tell you about tier 3, tier 4. Yes, the cost of acquisition is lower because primarily we are sourcing through banca channel in tier 3, tier 4, where the cost of acquisition, we have earlier also stated, is lower. The second point is that in those cities, State Bank of India brand is SBI card brand, because SBI is the mother brand. SBI brand is very strong. So the brand attractiveness and the pull factor is very, very strong. On the consumer behavior side, what we have continued to see is that the online percentage, even though the spend is slightly lower than tier 1 cities, but the online percentage, because of delivery now of the large e-commerce players in the country, is now easily there in almost all PIN codes. We see this 55% is almost similar in tier 3, tier 4. So that behavior is being seen. And the spends at the point of sale, because the availability of point of sale as it increases in tier 3, tier 4, we believe that should also help increase the spends further. So that is some color on the tier 3, tier 4. The spend categories are usually the same. There is a bit of a difference in terms of travel and lodging, where the travel spends are slightly lower compared to tier 1 cities or so. But if you talk about primarily utilities, your fuel and other non-discretionary spends, it is broadly the same.
And the average spends would be lower. What monthly spends would be like half of a tier 1, tier 2, or like any proportion or any number that you would want to talk about, like the reasonably seasoned customer who is spending X in urban or tier 1, tier 2 would be spending at least 40-50% of him, or lower?
We have not given the exact breakup, but it is what I would say anywhere between 60 to 90% of that, depending on the city wise.
All right. Sorry, sir. Last question is, the yields on the term book or the EMI conversion book would be around 16-17% or maybe lower?
We not declared the yield on the term book as yet.
Okay, sir. No problem. Thank you so much.
It can be calculated from the portfolio yield overall, transactor, revolver, overall portfolio yield.
Actually, you can, sorry, saying you can calculate it because you have the full base, and we have given the transactor, revolver, and EMI breakup. The revolver is at the product rate of 3.5% per month. So the balance you can calculate.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants, please limit your questions to 2 per participant. If you have a follow-up question, you may rejoin the queue. The next question is from the line of Parab Subramanian from Macquarie. Please go ahead.
Hello. Yeah, hi. Thank you for the opportunity. So my question is on incremental card volume market share. So if I'm looking at card volume market shares, it's down about 100 basis points, over the last 10 months or. Is this something you're concerned about, and could this translate to spend going forward, or do you think this is more low-value spend cards being added by the industry? Is this something you're concerned about?
I mean, one thing is the gross card issuance of the industry has increased over a period of time, so obviously that has an effect. But should we mimic what others are doing, we always maintain a stance of a kind of sustainable growth and looking at our return on risk capital capability, capacity of the channels. But I think the kind of numbers what we said while responding to other questions around what is the net growth target we are aiming for, I think that should help us actually in terms of arresting this decline and actually start gaining the share. This may be a very temporary kind of situation, but we have plans to ramp up both the gross card issuance and address attrition also in a meaningful way. Because our attrition will be definitely slightly higher than the industry because we issue only large GP-based cards as compared to competition. So that factor is always there, but that also helps us in having a better active rate in the portfolio also, portfolio of cards. So we will take all these things into account, but we will strike a balance between the market share gain versus, ensuring a sustainable growth.
Got it, sir. Thank you very much. So if I could ask again related to that question, is there an aspiration to be the number one player on a volume basis for SBI cards? So you obviously have the parentage, the brand, the bank's customer base. What is holding back SBI card from being the number one volume card issuer in the country?
So as I said, we have strategies and we are aiming for improving the market share. So that's very much there. Definitely the kind of sourcing what happens from the bank, we also revisit and always look for opportunities of maximizing it. But we are also mindful, the new master direction puts a lot of responsibility on finding the right customer, because if there is any forced sale or otherwise a kind of miscommunication to the customer, that may not result in any activation of the card, which anyway will have to be attracted after 30 days. So we need to look at the profile and we need to do the carding and targeting the customer in the right way. So definitely increasing the market share is on the cards, and we will do it in a calibrated way.
Got it, sir. Thank you very much. All the best and congratulations on the quarter.
Thank you. The next question is from the line of Nitin Agarwal from Motilal Oswal. Please go ahead.
Yeah, hi. Good evening, sir, and congrats on good set of results. So two questions. So firstly, again, around the borrowing cost and margins. So in respect to that, besides the mix of like revolver and EMI customers, which has increased this quarter, how much flexibility do we have to increase the interest rate for our customers, mainly the EMI customers, so as to protect our margins?
I think, as you know, the kind of EMI loans are all fixed rate loans. To the extent there is a healthy disbursement, so it gives us an opportunity for each disbursal to price it appropriately. Of course, we will look at our cost of funds and we will look at what is the ideal risk-based pricing, and of course we also look at what are the offerings from the competition. But it offers an opportunity for each new disbursal to pass on some increase to the extent market absorbs. Of course, the other effort will be to increase the share of interest-bearing NEA overall, while ensuring that the revolver doesn't dip from the current level. That will also help us in terms of increasing the portfolio.
Okay. And so secondly, like on the subscription-based fee, if I look at on a per card basis, this is trending downwards, though not any major decline, but for last 2 years also there is a downtrending that is there on the subscription-based fee. So how do you really see this playing out in the medium term, and any new products that we are looking to launch to counter this trend?
So subscription-based fees is primarily our membership fee, and that's linked to the new accounts which we are sourcing. And on a per card basis, it would be stable.
Hello, sorry sir, I missed you. Sorry, can you repeat that please?
I think subscription-based fee primarily includes our membership fees, and on per card basis it will be stable.
Okay. Maybe I also see a small decline, single digit though, but it's been around if I look at YOY, it's a 4% decline, and in prior year, very marginal decline is there. So is it to do with the mix where you are originating more from the tier 2, tier 3 cities because of?
So that's linked to, there are spend-based reversals as well. Our customers, as they touch the spend-based limits, they don't get to pay the fee. So the spend-based reversal percentage, because that keeps going up as the customer profile improves, the membership fee on the renewal side will start coming down. So that would be the impact of this.
Right. Got it. Thank you, sir. Thanks so much.
Thank you. The next question is from the line of Pankaj Agarwal from Ambit Capital. Please go ahead.
Good evening, sir. Sir, do you think RBI allowing credit card on UPI rails will benefit the industry?
So RBI has allowed RuPay credit cards to be used on UPI. As of now, if we look at it, we have almost more than 1 million plus cards already on a RuPay platform, and we are one of the largest issuers of RuPay cards in the industry. So we believe that there are 3-4 benefits which are very clearly there. One is the whole acceptance fees of credit cards into the P2M space for RuPay for UPI merchants, that should increase, and these are the merchants where if the acceptance happens, we would get incremental spend from the same customer. So one can get more share of spending which the customer today is doing on UPI can shift on credit cards for specifically for rewards, because rewards and other value proposition benefits are there. Market penetration increases. We also, as was being mentioned earlier, in tier 3, tier 4 cities, UPI is already very well penetrated, and in those cities we are very strong, and we are issuing RuPay cards there. So there the customer starts using. We should be able to see increased spending patterns there. And also, in any case, if the customer has one payment mechanism and he uses it for all the areas to make the payments, that it increases loyalty also. So we believe that these are the 3-4 areas where the benefit is there. There is obviously a discussion around what would be the commercials, what would be the interchange and MDR, which would be there. So that discussion, NPCI is already having that discussion with all the member banks, and you would have read the interviews also of NPCI CEO and MD. So they are already in discussion, and we believe that something which is right should happen in due course.
Sorry to interrupt, Mr. Agarwal. There is a lot of background disturbance which is coming from your line. May I request you to mute yourself when management is answering your question?
Am I audible?
Yes, sir, you are. Please go ahead.
Sir, there was, I think, somewhere it was mentioned that on small value transactions there might not be any kind of MDR. So in that context, do you think that there could be some cannibalization where merchants shift some of the credit card transactions to UPI? You know, the India is a jugaad country, right, where merchants can play that game.
So you are right, and I think these are the topics of conversation which are actually precisely happening with NPCI, that how the mechanism has to be done, if there are benefits which has to be given to the merchant for certain categories which are smaller merchants, how will that be monitored, what will be the control mechanism, to what level, what ticket size that transaction should be allowed for. So there are these questions which are there, and I think that is what NPCI and other banks are discussing before they come to the final conclusion.
Okay, sir. Sir, one last question. In the last cycle, your cost of funds had gone to up to 8-9%. I think somewhere between 8 to 9. Do you think it can go back to those levels, or structurally your liability mix has changed so that it will remain, around the current rate?
Difficult to predict the trajectory of interest rates, but as of now there is upward bias definitely because of inflationary pressures. But over a period of time, what we have done is you would have seen like the share of long term we have been really, in a focused way, we have been increasing the share of long term. So we have been looking for opportunities to lock into long term at a right rate. So this journey will continue, even though it is slightly costly as compared to short term. This will help. And of course, to the extent, even if there is an increase in the cost of funds, to the extent we are able to increase the share of overall interest-bearing NEA, and to the extent the revolver helps, I think that can act as a mitigant.
Thank you. Ladies and gentlemen, request to everyone to please limit their questions to one per participant. The next question is from the line of Karthik Chelappa from Buena Vista Fund Management. Please go ahead.
Yeah, thank you for the opportunity, sir, and congrats on the quarter. My question again is on this UPI on credit cards, for which the negotiation is still underway by NPCI. I'm just trying to get a sense, maybe this is a bit of a theoretical question. How much of the unit economics actually hinges on the MDR? Is that something which the industry is quite particular on? Or to ask it in another way, if the MDR were to be lower, would you still go ahead with the product and tinker other cost elements to keep the unit economics the same, or do you still feel that you need a certain degree of MDR for the product to be successful?
So you need MDR, and there are three reasons for it. The first reason for it is credit card is up to 52 days of credit-free period. Okay. So there is a cost of funds, which is when the customer spends on an average, there is a cost of funds which as a issuer we incur. Okay. The second thing is a customer uses credit card also because of the rewards and the benefits and the value proposition which the customer gets. So there is a cost of value proposition, and then there is a cost of rewards also. Now you can tinker with, if there is a high premium end of it, where we get higher interchange, then you can give higher rewards to those customers. At a lower end, you can give lower rewards, and you can tinker with that. But not having rewards at all and having just a base payment product will not encourage the customers to have either loyalty or spend large ticket items on the product. Okay? So that's the second piece which is critical. Thirdly, obviously, it is a credit product, so there is while the credit loss you can still look at in terms of from the interest income and other things, but there is a set of fraud loss also, which happens, which is born at the initial stages, even though that is very low because of the RBI guidelines of second factor authentication and generally a very secure environment of chip and pin. So it's very low, but there are those costs which are different in credit card compared to any other simple payment product where the money is going from your bank account.
Got it. So just one clarification to the point that you made earlier to a question on incremental market share, which has actually slipped quite a bit. What do you think will take for SBI cards to possibly reach a 400 or a 500,000 card issuance per month? Do you think it's the technology backend which you still need to strengthen in terms of capacity, or do you just think it is underwriting appetite which will improve as the economy actually improves? Because the inherent demand seems to be very high.
I think it's a combination of everything, and we have been making efforts. Of course, the declining credit costs, which we have demonstrated over a period of time, definitely gives us the maneuverability to experiment more with some pilots, which we have been doing. We also talked about having the ability to consume alternate data for underwriting the NTC and NTCC customers. So that definitely that is helping. And of course, technology-wise, we said like the NTB, the journey is already there. This is only for the organic inflow. This platform has to be extended now to the entire partner ecosystem. So that will also help us in terms of ramping up the numbers, but at the same time at a reduced cost as compared to the current business model. So it was a conscious move. I mean, technically you can even get those numbers even in the current business model, but the cost of acquisition will be high and the incremental returns may be less. So that is the reason we are making calculated moves.
Thank you. The next question is from the line of Rahul Jain from Goldman Sachs. Please go ahead.
Thank you and good evening, everyone. Just to start with, first on the spends per card in retail, which we understand is about 130,000 rupees per annum, which seems to be the highest that you've seen. Just wanted to understand, where can these spends go from here? Particularly in context of the income that your customer would be earning. So that's question number one. Question number two is, again going back to the market share point, if the market share is incrementally coming under pressure, then what levers do we have to keep increasing the spend? If in case the spends per card start to flat you out. So those two were question around just to understand the movement forward in terms of the spend market share.
So you are right. First of all, on the spend per customer, okay. Now we've been stating that the spend per card or spend per customer has actually been increasing over a period of time. So during COVID, it went down because certain categories were not available. But we had stated at that time also that those categories have come back, and the new categories, the existing categories like travel, lodging, hotels, they were bound to come back at some stage when the normalization happened, and which they have come back. So we are seeing that increased spend which is happening. The second thing is, this digitization process is actually picking up further steam. So you see more and more new categories coming up into the fore. There are school and education as a category is fairly decent now. Rentals which were not there, let's say a year or year and a half back, is a fairly large category now. Utility bills otherwise, insurance payments. So you will have deeper penetration, because when these categories come, the first thing, not everybody picks up those. So out of 14 million customers that we have, not everybody is spending on all the categories. So we keep increasing the depth of categories within our customer base to get that spend increase. So there is this is a standard segmented offers, campaigns that we continue to do to get that piece. On your question on market share, you are absolutely right. If the market share on cards does not increase over a period of time, it will put pressure on the market share on spends also, because both of them typically are in tandem. And overall spend share will work on number of cards and the spend per card. It's a standard mathematical formula. So the first step here is to get the market share on the cards piece to increase. And that is what we are working on. And as was stated by our MD, that while we are working on in calibrated fashion, but the numbers, we now have a straight-through processing which we have launched for our open market. We are also trying to link it to our banca sourcing so that we are able to get benefits there. This should be completely incremental. New co-brands is completely incremental, which is going to come. And in the existing piece, we are working at a lot of productivity increase measures and efficiency increase measures so that we are able to, at a lower cost, or at least keeping the cost same, get the productivity up and be able to source more number of cards. So those things are in progress, and we are seeing some very good results in the month of June, and we believe that those should continue further growth over a period of time, and this growth of market share should come back to us. So that's on the cards piece. While on the spends piece of it, there is a corporate card piece which we have always talked about. We want to be very careful where we go there, because there are those two portions there. Retail has been running strong. We want to continue to keep the corporate card also in the play, but still at a profitable and at least at a marginal profitability level should be maintained. So these are the two portions that on which the work is happening.
Thank you so much. That was very helpful. Just to follow on, one is in terms of the spends. When you look at these spends vis-a-vis the income that your customer, the spender would be earning, what would that be? Any sense can we get? What would the average annual income of your typical customer? Spending 130,000.
Okay. So not connecting everything to income here does not work. Okay. So because income is important. So for example, in tier 1 cities, it's actually the consumption spending pattern which is more critical. So when we look at the customer database, or when we look at some of the customer profiles, while credit limit, which is being set, is basis some bit of income estimation and increased or decreased basis the income estimation done by the credit team. So spends in various categories. So for example, everybody today spends on fuel. Okay, whether it is especially if they have a credit card, they will spend on fuel, whether it's a two-wheeler or a four-wheeler or otherwise. The quantum will be different. So you approach it from a spend category perspective. And as we have earlier seen, we look at it from a non-discretionary and discretionary. So non-discretionary spend people will do. People will go to departmental stores and buy their regular groceries. Whether they buy it on a card or cash is a choice which they have. So we have still not reached that level that the monthly income, the spend is crossing the monthly income by a large margin. Those things have not happened as well.
Thank you. The next question is from the line of Adi Jain from Ampersand Capital. Please go ahead.
Hi sir, congrats on a good quarter. I just had two questions. So the first one was actually NIMs. So I've noticed that our NIMs have fallen from around 50.
Sorry to interrupt you, Mr. Jain. We cannot hear you clearly.
Hello, am I audible now?
Yes.
Yeah. Hi sir, I just had a question on the NIMs. So I noticed that our net interest margin has fallen from 15-16% pre-COVID to currently 13%. So I just wanted to know what could be the reason for that. One thing I noticed was that our revolver share has fallen. So is there any particular change in consumption pattern or customer behavior towards revolvers? Are you noticing any of that? And what could be a sustainable NIM range for the medium term?
You are right. I mean, the decline in NIM is mainly attributable to the lower share of revolver. But the way to look at it is how we have been managing the cost overall. Even when the revolver is at 25-26%, still we are able to generate a return metrics of return on average of 7% and ROE of 30%. So I think the revolver to consumption, is there any linkage we can see? So there will be some tendency, like when they are buying a consumer durable item or otherwise make a big ticket purchase, like a travel, etc. I think there is a better propensity to revolve. But barring those categories, linking it to consumption is difficult. I mean, revolver is more to do with the ability to pay in full. If it is not there, then obviously they will choose an option of, if it is a short-term kind of cash flow mismatch, they will think like in a month or two they will roll over and they will pay. Or if they are comfortable paying over a period of time, they will opt for EMI kind of loan.
Thank you. The next question is from the line of Deepak Sunavne from Haitong Securities. Please go ahead.
Yeah, thank you, sir, for the opportunity and congratulations on a great set of numbers. So just wanted to understand profitability. I mean, if we compare our online spends versus offline, that is spends at POS, and if we compare the profitability in terms of let's say net profit per spends. On blended basis, we are reporting around 0.8 to 0.9%, right? And if you split that profitability base between the online spend and offline, can you give us color on this?
Okay, so profitability from the category of spend does not vary. It is dependent on more on category of customer that we are getting. So premium customers with high spenders are more profitable. On MDR front, because on what is online or offline, it actually depends on the kind of spend. So if travel, if you do, whether you buy it from a point of sale or you buy it from online, one of the players, we get the same interchange. So there the variation is not there. So from an income stream perspective, it is actually no difference. The profitability is actually more customer dependent rather than the online offline.
Thank you. The next question is from the line of MB Mahesh from Kotak Securities. Please go ahead.
Good evening, sir. Just two questions. One, how much of your incremental cards or outstanding cards would be on the basis of a secured credit card? In the sense, it's backed by fixed deposits or any other linked instruments?
We don't have the numbers, but it will be insignificant.
Very.
It will be very small.
In the sense that we've seen some competition kind of introducing this being a very good source of getting into customer segments which are tougher to crack from an income segment. What is your sense of this as a product?
So we did this product for 2-3 years. The attrition rates are very high. So even within the first year, because customer is, as it is, marginal, and his need for breaking the FD can happen at any point of time between 3 months to 9 months. So we saw a whole lot of them wanting to break their FD after 6 to 9 months. So the life of the customer with the product was not very long, and hence automatically the profitability gets impacted majorly because you incurred a good acquisition cost upfront, and if the customer does not stay longer with you, then the opportunity to have revenue from that customer is limited.
Perfect. And second question, sir, this is to Aparna ma'am. Ma'am, this 450 crores of provisions that you're doing there, this still continues to remain of customer base which are, let's say, pre-COVID, or these are a business as usual kind of a credit cost that we have hit now of the incremental spends that is coming in?
Now the credit cost is BAU largely, and if you look at our ECL rate that we've given out, it's at 3.3%, which is actually lower than the pre-COVID rate. So a lot of the RBI RE book is almost finished. We have got 150 odd crores of that left. There is just 61 crores of discretionary reserves. So whatever you now see is BAU.
In a sense, these are customers who have originated, let's say, pre-COVID, or these are, let's say, customers who are still coming out of the incremental book that you originated? I'm just kind of going in that direction of the question.
So I don't think it's a question of whether they've been sourced pre-COVID. This is the standard expected credit loss model that we have that looks at 7-year data, and we are able to project what would be the losses. For the high-risk segment, specifically the RBI RE, we had made specific provisions. That is now finished. Whatever you see is a standard provisioning model now.
Okay, perfect.
So, some of them could be in recent times, some could be older, but this is the BAU model now.
Perfect. Understandable. Thank you for this.
Thank you. The next question is from the line of Saurabh Mehta from East Lane Capital. Please go ahead.
Yeah, thanks for the question. I had two questions. First thing was I wanted to understand volume-wise the mix of the corporate and retail spend. Like how much percent of our cards are corporate and retail? And follow-up to that was what is the retail spend per card, and how long do you think a retail customer could reach, say, a 2 lakh spend, and what will be the drivers for that? Thank you.
So in corporate, the number of cards is very minimal. So we would not have more than 50,000-60,000 or so. So cards is it's basically a large spend coming on one product. So whatever you see when we say 14 million plus cards, it's essentially retail cards that we are talking about. And we have declared the retail spends also on quarter-by-quarter basis. So the average spend you can calculate. The number you talked about a particular number. All we can say is that, as I was mentioning earlier, that different new categories have come. We have seen the increase in the customers' spend per card. And if we go by vintage analysis, because newer customers take some time to build their spend, actually the spends of some of the older vintages would be closer to that number. So as we are adding more cards, those new cards when they come in, initially their spends are lower, and then they build up over a period of time, in a period of 18 months to 24 months. So this is a continuous cycle because customer also gets comfortable with the product. We also educate them. We also tell them about various offers in various categories. Once they start using that product, they use it with multiple categories. So it's a progressive exercise that happens. So if you see customers who were let's say 2015 or so, a whole lot of those customers would have already reached that number. So average is more weighted averages move, and what you see today as a number is a weighted average of the overall portfolio.
Thank you. Ladies and gentlemen, this will be the last question, which is from the line of Rohan Mandora from Equirus Securities. Please go ahead.
Good evening, sir. Thanks for the opportunity. Sir, a data keeping question that I had was, in terms of the new categories which have come up post-COVID, what will be the contribution in total spend from them? Or where the use cases where the spend momentum has improved?
See, if I take rentals, some of your insurance bill payments and utilities, these categories can contribute anywhere between 10 to 20%.
10 to 20%, okay. And so secondly...
Yeah. Variation is there.
Sorry?
On a month-on-month basis, there will be variation because certain categories insurance is more skewed towards March versus some other months. So monthly variations will be there, but that is the range.
Sure. And so what will be the difference in the spends per active card in banker versus non-banker and also the revolve rate?
Actually, spend per active card in banker versus non-banker is almost similar. In banker, we have to work slightly more towards getting the activity percentage of the customers active to be higher. So, the customer will start using the card, fortunately start using at almost the same level. It is about getting more number of customers to start using the card and use it fully. So that is and use it continuously in a month, because we want our customers to use the card every month. So, and that is the trick about it.
Sure,
slightly lower in banker as compared to, I'm talking about the revolve rate. You asked for a revolve rate in banker. It's slightly lower as compared to open market, but you also have benefits basically by way of having access to the operating account. So collection and recovery, you don't spend that kind of cost, and automatically you have the benefit of lower delinquency credit cost as well. So I think we need to look at overall. I mean, while it may not revolve, it will also not lead to complications downstream in terms of collections and recovery.
Sure. And then lastly, the spends which are getting converted into EMI, what will be the average ticket size in that? Like what kind of spends averages get converted into EMI, some ballpark range?
It's around 20 to 25,000.
20 to 25,000. Sure, sir. Thanks a lot.